Well, hello everyone. Welcome to another webinar in our webinar series today with Sprout Agribusiness. My name is Glen Simmons. I'm a succession planner with the company, and I travel anywhere across rural New South Wales, Queensland, and Victoria, and across the nation, facilitating succession with predominantly agribusiness and farming families, and as part of my role, we like to educate the community to make sure that they're up to date with certain things that are happening that is relevant to their business. And one of those is the CGT changes that have been going back and forth with our current government, particularly with different trusts. And today we're talking about testamentary discretionary trusts and the benefits of this and how it could help your family move forward within some transition planning. Today, I'm joined by Taryn Gollasch. She's a lawyer at Regional Business Lawyers in Wagga, and she specialises in wills and estate planning. So she's done some amazing research on this topic and has tried to keep up with the government changes and put it into very practical layman's terms. So she'll be the primary presenter today. So I'll be facilitating the conversation. Just some housekeeping. We'll have a bit of time for some Q&A at the end. So if you've got a question, please just type it into the Q&A section of the chat, and we'll be able to hopefully get to that at the end. But if it's a little bit too niche or a bit too hard at the moment, we'll be able to come back to you as well. So we appreciate that all advice today is general. So if you are considering making some changes within your own family and business, please seek third-party advice before you do so. So without further ado, welcome, Taryn. How are you?
Thank you very much, Glenn. I'm very well, thank you.
That's good. I'll just share my screen and we'll get the PowerPoint up. I'll make it go full screen. Oops. Right, can you see that, Taryn?
I can, thank you.
Beautiful. I'll just 1 second. Sorry, everyone, I'm just having a little trouble here. Just making sure I can see my notes at the same time. We'll let everyone just sip their coffees for a little bit. Right, Taryn, just make sure you let me know when you want to go to the next slide. But kick off.
All right, so part one. What happened to part one?
Part one's here, sorry.
Part one is an introduction to testamentary discretionary trusts. So firstly, what is a testamentary discretionary trust? It is a trust whose terms are set out in a will. It is a trust which comes into existence after the death of a will maker. And it is a trust that gives the trustee discretion as to which beneficiaries the trust income and capital is distributed to. So how does it differ from other trusts? Well, it differs from an inter vivos trust, which is a trust set up during someone's lifetime. For example, a normal family trading trust or a landholding trust. It differs from a testamentary bare trust, which is found in simple wills, where the will maker says in the will that the executor is to hold certain assets on trust for a beneficiary for a certain period of time, for example, until they reach 25 years of age. And it differs from a testamentary fixed trust, which sets out in the will the terms of the trust, including that the trustee is to distribute a certain asset to a certain beneficiary at a certain time. So, usual elements of a testamentary discretionary trust. There must be trust property, which is the assets of the will maker. There needs to be a purpose of the trust. There needs to be a trustee, which could be a natural person or a company. And you would need a primary beneficiary and other beneficiaries. You will also want to have an appointor, who is the person with the power to remove and appoint trustees. Now, when should a testamentary discretionary trust be used? The rule of thumb is when the testator has at least $500,000 of investable assets in the testamentary trust once the estate is administered. Another reason to have one is where there are children or grandchildren under the age of 18 who could each benefit from receiving $22,866 of tax-free income each year, or where it's important to the testator that the inheritance is protected from a relationship breakdown, or where the testator considers that the beneficiary needs protection from themselves or from third parties. Or, perhaps most relevant to this audience, is where the testator has assets such as farmland held in their own name or in a company and desires to provide flexibility for succession planning in the future. So if any one of these factors is present, a testamentary discretionary trust is worth considering. Although if the estate is small, it may not be worth it due to the administrative costs. So moving on to part 2 of our presentation, which is the benefits of a testamentary discretionary trust. So a summary of the benefits is threefold. There are tax benefits, there are asset protection benefits, and there is flexibility for future succession. So if we look first at the tax benefits. Prior to budget night this year, testamentary discretionary trusts have had special tax treatment over other trusts. That is, that minor beneficiaries of testamentary discretionary trusts are treated for tax purposes as an adult and therefore could receive each year $22,866 tax-free from the trust. The rationale for this was that someone had to die, a parent or a grandparent, for this tax treatment to apply. So if that child could be provided for under the trust, that compensated them somewhat for the death of their provider. So by way of an example, Dick and Jane are married. They have 3 young children. Dick dies in a farm accident. His estate receives $600,000 from his life insurance. He also had $200,000 in shares. He had a testamentary discretionary trust will in place, and his will directed that his life insurance proceeds and his shares were to go into that trust with Jane and his 3 children as beneficiaries. Jane is the nominated trustee. She invests the life insurance and keeps the shares and is able to direct $68,598 of the annual income from this investment to the 3 children who pay no tax on those returns. So this has helped Jane keep the family afloat after Dick's death. So the Albanese government threw the estate planning community into a spin with their budget night announcements, which included the imposition from the 1st of July 2028 of a minimum 30% tax at the trustee level on trust income in discretionary trusts, including discretionary testamentary trusts. So this was to exclude testamentary discretionary trusts already in existence, but not those which had been prepared and signed, but with the will maker still alive. So after serious lobbying, the Albanese government dropped one element of their proposed tax changes and left the tax treatment of testamentary discretionary trusts alone, which is great news. However, they have proposed 2 catches. To avoid the minimum 30% taxation of trusts, future testamentary discretionary trusts must have the following 2 characteristics. Firstly, the exemption from the minimum 30% treatment only applies to income generated from assets of the deceased estate, not income generated from assets added to the trust afterwards. Now, this has been applied to testamentary trust income since 2019, so it's not actually new. But what is new is for testamentary trusts established from 1 July 2028. The exemption is only going to be available where the trust benefits individuals and income tax exempt entities such as charities, not companies and not other trusts. So for testamentary discretionary trusts that have already been prepared and signed, where the will maker is still alive, our position is that the will should be reviewed either to remove companies and other trusts from the list of potential beneficiaries, or to include a conditional restriction preventing such entities from benefiting from the trust if it would jeopardise the exemption applying. So once we know what the legislation actually says, then we will be able to refine this position. But back to Jane. Jane also has a testamentary discretionary trust in her will. She's coming to see us next week and to make a change to the terms of her will to add in that conditional restriction on companies or trusts from benefiting under her testamentary discretionary trust. Okay, now we're moving on to the second benefit of testamentary discretionary trusts, which is the asset protection benefits. So these trusts allow you to protect your inheritance from your surviving partner repartnering. This is one element. To enable this, your assets would go straight into a testamentary discretionary trust for your children and grandchildren, and also your surviving spouse. However, it may be better to have the trustee as a third party, such as an accountant, so that your surviving spouse isn't in control of the trust, which makes it more likely to be considered an asset of the marriage in a later relationship breakdown. So back to Dick and Jane. Dick and Jane are married. Dick is still alive. They owned land together, but most of the land has been handed down from Jane's family over generations to Jane. Jane is worried that if she dies first, that Dick is going to be seduced by some floozy who'll end up taking all her family's land. So she has a will prepared with a testamentary discretionary trust for all her land interests, with Dick and her children as beneficiaries and their accountant as the trustee. Dick knows that if he dies first, there is no way known that Jane's going to remarry. She's really had enough of marriage. So he's happy for his interest in the land to go straight to Jane in his will if he dies first. Then when Jane dies, all the land will go into that testamentary discretionary trust for the children. Now, the other some more other asset protection benefits. A testamentary discretionary trust can also protect your inheritance from a beneficiary's bankruptcy or from them being sued, for example, if they're in a risky profession such as medicine. Testamentary discretionary trusts can also protect beneficiaries from themselves, for example, if they have a gambling addiction or they're mentally ill or they have a disability or are vulnerable to people exerting influence over them. In a farming context, having a farm in a testamentary discretionary trust separate to the operating entity can protect the farm from the operating entity or individuals in a partnership being sued for a workplace accident or a public liability incident, or from creditors or from bankruptcy and insolvency. Now, in the structuring and drafting of a testamentary discretionary trust, you can also put in place restrictions and limitations on the use of capital and income. For example, perhaps a spouse, especially say a spouse from a second marriage, receives the right to income and or perhaps the right to live in an asset owned by the trust, but not the right to the capital, which is an alternative to giving them a life estate, which does have complications. Another option is capital might be able to be distributed, but limitations imposed to protect the amount of capital. For example, there has to be enough capital remaining in the trust to provide for the education expenses of the children or the grandchildren until the youngest of them turns 25. A further example, where the trust is being set up to protect against difficulties of a beneficiary, you can add more limitations around their access to capital and their use for the capital and nominate an independent trustee. I also want to mention here the existence of special disability trusts. This is a specific type of trust for disabled beneficiaries that, if it meets the ATO guidelines, it won't affect the rights of the beneficiary to receive the disability pension and the various benefits that are associated with receiving that pension. So for particular families, this might be a very useful tool. Now we're on to the third benefit, which is the flexibility for future succession. This benefit is particularly useful for family businesses with significant assets, such as farming families, where it's not yet apparent which children are interested in farming, and therefore how to split up the land on the parent's death, or where the parents are hopeful that the asset will remain in the family for generations. There are a number of options available. For example, say you have 4 blocks of land and 4 young children. You can put all the land into one testamentary trust with all your children as beneficiaries until it becomes clear which children want to farm and which ones don't. Or you could specify that each block goes into a separate testamentary discretionary trust and the off-farm assets go into a 5th testamentary discretionary trust with all the children as listed beneficiaries under each trust. Then after your death, in due course, once it becomes apparent that 2 children want to farm and 2 don't, the trustee can replace themselves with the 2 farming children as trustees of 2 trusts each, and the 2 off-farm children as trustees of the 5th off-farm assets trust. The trusts can either stay on foot until these children's own children or grandchildren grow up. These trusts would have a maximum 80-year life, or the trust can be wound up and the assets distributed to the relevant beneficiaries. You could also set up one testamentary discretionary trust for each child and choose 1 block of land for each child, and regardless of whether they farm it, the land is theirs. They could lease it to the sibling who ends up farming, or have their farming sibling or a third party share farm it or do contract work for them, or they could sell the farm to that sibling in due course. At a certain age, if you do so stipulate, they become the trustee of that trust, and it can stay in that trust for up to 80 years if that's what they choose, or they can wind it up. The trust structure allows the trustee role to change to the next generation at the relevant time, rather than the land itself changing ownership, which would have capital gains tax implications. So you're therefore delaying those tax costs until the trust is eventually wound up. So in summary, it's definitely worth considering having a testamentary discretionary trust will due to all the above benefits. And if you do have a testamentary discretionary trust will, do get it reviewed by your specialist estate planning solicitor due to the changes that are on foot at the moment.
Thank you,
Thanks,
Taryn.
Glen.
I've got I might ask a few questions, probably on behalf of the audience. A few of these, but seems like a very, very powerful tool and a very great tool to have in our toolkit as we work in succession. But particularly this one, would you agree that this might be a appropriate path to take, say, for a family sort of looking to the future of succession and transition, whatever else, and their kids are quite young and like really young, and we're not really sure what path they're going to take. Is this a bit of a nice safeguard or first step that they could put in place?
100%, Glen. Absolutely. It's good for anyone who hasn't started the succession planning process, but I would also say it's good for anyone who is in the succession planning process, no matter where they're up to in that stage. Say they're planning on transferring their land to their kids in the next 5 years, and that process is afoot. You just don't know when there might be an accident.
Sure.
So they should have the estate plan in place now with that testamentary discretionary trust in place. And then after the succession planning happens, they can revisit that. It might not be necessary for them to have it. But the next generation, now they've got the land, they should be thinking about putting the testamentary discretionary trust in their wills. So it doesn't matter where you're up to, whether you're at the receiving end or the giving end in the succession planning stage. it's worth having at least considering it
Of
in your
course,
estate plan.
of course, that's right. And obviously, as we all know, as we sort of move through, changing of entities and sort of changing of names and titles and what owns what, CGT can be triggered left, right, and centre, regardless of any sort of small business concessions as well. With the Testamentary Discretionary Trust, so I've got 1,000 acres on the edge of Wagga, but my family's owned it for 4 generations and has actually been personally in our partnership for, say, 25 years. And I move it into it's signed up as part of that will. What happens is, from a CGT perspective, is it rolled over? Is it cancelled? What happens there?
So, luckily in Australia, as you would have all heard in the news lately, we don't have death taxes.
Mm.
So, if something is transferred after someone dies to a beneficiary, whether that beneficiary receives it in their own name or whether they receive it in a testamentary trust, there's no capital gains tax payable on that. We call it a transmission of the asset as opposed to a transfer.
Mm.
The no capital gains tax payable, it just gets rolled over. It doesn't get exempted, it just gets rolled over, delayed, basically, until that asset is eventually sold. So if it just keeps getting transferred under people's wills, then that CGT will never be realised.
Mm. Yeah, spot on. Look, from a facilitation point of view, guys, we just want to make sure that whilst this is, and I've got to agree, this is a very powerful sort of feels like the golden bullet in a way, but you need to make sure that you seek third-party advice to make sure that this is appropriate for your family and business, because you might have some very, very active members that are very senior within the business that may be quite opposed to what this looks like in the future, and you really need to have sort of larger, sort of more encompassing family conversations to make sure this is appropriate as well. But as well as sort of asset protection and the land entities, we're mainly looking at the land and everything else here, as the trading entity might have a few sort of machinery and everything else, but we need to make sure we don't forget the other elements of succession planning when you're thinking about this sort of thing with your family. You need to make sure that all the decision-making processes are in place, the proper governance, right? So what's the hierarchy? What does that look like? Roles and responsibilities within the business, what it looks like now, what it could look like in the future, how are things working, how could things work a little bit better? What's your employment policy as the next generation comes up through, right? These are all discussions that you need to have. And I spelled that wrong, but as well as the pay as well. But family dynamics, as well as on-farm, off-farm siblings within the business and how that sort of flows through. Financial viability, what can the farm really afford from a cash flow perspective, servicing debt, as well as how the owning generation moves out of the business. What sort of personal cash flow is that going to look like? I know this is separate to the trust we've been talking about, but these are the other elements you need to think about, as well as what we think about with the land. Future roles and compensation, and generally the winding down of the next generation. So we'll just move on. I'll just see if we've got any. See if we've got any questions here, Taryn. I'm not sure if you can see the.
Yeah, I can. If you want to read that first one out, I can have a go at answering it.
Yeah, one here from Tim Mort.
Thank
you.
Okay.
Thank you, Morty, for your question and joining us today. What about transferring from a partnership into a trust? Does it trigger stamp duty at death, or is it exempt from stamp duty as well?
Oh, stamp duty. My understanding is that a transmission on death under a will is only subject to nominal stamp duty, so $100.
Okay.
Yep.
Um,
So that is what you're looking at. If you yeah, there's a sort of an intricacy to this question, because often partners own, say, 50% each in the land and they make it available for the partnership. So
Sure.
on your death, in your will, you are transferring your 50% interest in that land to your beneficiaries.
Yeah. Okay.
And your beneficiaries, in this case, are a Testamentary Discretionary Trust, and it's stamp duty exempt as long as it's in conformity with what the will says.
Yeah. Yeah. I'm sure if there's any more detail, we can speak to Tim a bit later. And we've got an anonymous question here. I'm not sure if you've read it, but
Yep.
or if you can answer. Please confirm that
Yep.
the changes that are proposed to be implemented shouldn't impact a TDT that was set up 20 plus years ago. If this is the case, then there will be some changes. Can you please specify what those might be, Taryn?
So my understanding is if what you mean by it was set up 20 plus years ago, that means that the person who put it in their will died 20 plus years ago, and the trust has been operating for the last 20 years. My understanding from everything that's come from the government is that they are not touching existing testamentary discretionary trusts. So you're safe.
Wonderful. Wonderful. Hopefully that brings that participant a little bit of respite there. So, look, as we said, if you've got any questions around succession or particularly trust, please give Taryn a call or myself. We both work in the same space but have very different roles and complement each other. And so we really appreciate you jumping on today, or if you're watching our recording. Thanks for watching. But it's a developing space as well. So please note that this was recorded on the 21st of July. So thank you, Taryn. And
thank you for having me, Glen. And I genuinely hope that people have gained something from this seminar.
Absolutely. So have I. All right. Thank you, everyone. And join us next time. Cheers.